company bank account is your personal piggy bank? Not too fast. Today I want to explain what Division 7A is. Think the company bank account is your personal piggy bank? Not so fast. If you take money out the wrong way, the ATO calls it Division 7A, and it comes with some painful tactics. Today I want to explain to you what is Division 7A, why do you and your company need to know about this, and how the rules just got a lot stricter. Hi, I'm Jamie, CPA and small business CFO at Blue Money. I help business owners understand their numbers and avoid expensive mistakes. And Division 7A is one of the easiest traps to fall into, but one of the easiest ones to avoid once you've understood the rules properly. Firstly, and most importantly, you and your company are separate when it comes to a Pty Ltd in Australia. Here is where some small business owners go wrong. You and your company, once you sign up for a company and an ABN, you and your company become separate legal entities. Think of it like you're two separate people. The company earns income and holds cash, and you, the director or shareholder, are not the company. You just run the company. So if you take out money without declaring it properly, it's the same as if you borrowed money from a car finance company or a bank. It's not free, and it needs to be accounted for correctly. It could be a loan or income to yourself that is being accounted for. So what is Div 7A? Division 7A applies when a private company lends money, makes payments, or forgives debts to the shareholders or directors. If you don't treat those withdrawals properly, either as wages, dividends, or a formal loan between you and your company, the ATO will declare and decide that it's an unfranked dividend, which basically means it's taxable personal income to you. So, for example, let's say you transfer $20,000 from the company account to your personal account. In Xero, you kind of just coded it to your loan account because you paid it to yourself. So usually you'd maybe code that $20,000 to wages, and then we've got the payroll taxes applied. If it's a dividend, we'll calculate the necessary taxes and pay for it, or a proper loan, so you can document and repay the loan back to the company. But if you do nothing, the ATO will just put the whole thing unpaid dividend and you'll be taxed personally. So yes, if you're asking, can I take money out? Yes, you can, but it has to be a loan. And if you are loaning the money and you plan to repay it, the Div 7A rules must be followed. So firstly, there must be a written loan agreement and there must be commercial terms. You must be making minimum annual repayments every year, and there's an interest rate which must be matched the ATO's benchmark rate. For years, the interest rate sat around 4%, but in 2023, it's more than doubled down to 8.27. So if you loan money from a company, you must be paying it back at a market rate interest rate. If you're sitting on a $100,000 Div 7A loan in your company and your annual interest charges just jump from $4,000 to $800, it could make a big difference. If you don't meet those conditions, the ATO can reclassify this transaction in your file and you'll have to back pay any of the taxes. Why does Div 7A exist? I know you're thinking this is crazy, it's outrageous, but why is it also strict? And because without Div 7A, directors could basically drain their company accounts tax-free. These rules make sure that money coming out is either income or a loan on commercial terms and not just free cash. So during COVID, the ATO was really lenient. Businesses built up tax debt because they could, and many thought paying their tax bill was optional. However, now the ATO is owed a lot of money and cracking down in this area. Payment plans are getting harder to get, and I've seen business owners forced to refinance their homes just to pay their tax debts. And Div 7A is one of the contributions that was really the reason why the tax debt couldn't be paid in the first place. Add a Div 7A mistake on top of that, and the situation can become unmanageable. manageable fast. With the ATO crackdowns, tax debt isn't optional anymore, and Div 7A mistakes could make it worse. So here's the takeaway. You and your company are separate. If you take money out, it has to be treated properly. Wage, dividend, or structured loan at the ATO benchmark rates. Get this wrong and the ATO may treat it as income. Get it right and you'll stay compliant, avoid nasty surprises, and keep in control of your cash. If you want to know exactly how to pay yourself properly, I cover this in my Bookkeeping Boss Academy. So make sure you're staying compliant, guys.